I mean, there will be carry so long as capital markets function as they were designed to function. As long as risk is rewarded in capital markets, in other words, the risk of tying up your money in equities and not knowing, deferring consumption to buy equities, not knowing what price you're going to be able to sell those equities out in the future, that ambiguity, that's a risk that you are taking on to defer savings or consumption today. As long as people demand higher compensation for locking their money up longer in the bond market, as long as um, the markets that are funding commodity producers like or prefer lower variability in cash flows to higher variability of cash flows, then the carry premium will exist, right? It will fluctuate as central banks do their thing and as the economy and inflation do their things. But the reasons for carry to exist are timeless if you believe that markets operate in a certain way for a specific reason and that investors are not risk seeking. They don't prefer to lock their money up for negative returns versus consuming something that they want to consume today, for example.
Unless they're very specific commodity investors or something. But we won't go down that rabbit hole. But so that made me immediately think, okay, I have an artificial zero interest rate period. That would seem like a period where it could quote unquote break or be weird at least, right?
I
And
just think it's
maybe
got,
in the bond side, but is that the case for commodities? But
Yeah.
again, going back to different areas, different contracts, different markets will have attractive carry, and at times it won't be worth investing in that or taking any risk because there's like the example Adam gave earlier, spot contract is 60, futures contract is 60. There's no value there until the market has to demand a switch so that speculators are willing to take a risk to hedge out the producer's risk, right? So this is dynamic markets all of the time. And yes, there are going to be economic scenarios in which a single contract, a single sector will be less attractive than others. And this is where we get back to, no, you shouldn't blindly just be buying anything that has a positive carry. You should be thoughtful about selecting your asset classes based on numerous signals that we can call carry, that are
Mm.
reasonable to say, hey, that's a carry signal that we might want to use to select amongst many others. Much like trend following isn't just, are you above the 200-day moving average or below? Yeah, you'll make money over time by selecting a trend following managed future strategy on the 200-day, but you may be better off by using that signal plus the 100-day moving average plus a 2-month crossover with a 5 months, but some breakout systems. There's multiple ways to define what trend is. And similarly, there's multiple ways to define, in our view anyway, what carry is and help us to diversify our signals as well, right? So I think this idea that trying to put a blanket statement, well, when we're at ZERP, then there's nothing there, not necessarily true.
Right. Well, you could use the crude oil during COVID as an example, right? Nobody cared what the interest rate was. There was too much oil. We don't want the oil. I don't care if it's free.